Joining us today to present is our staff member, Tyler Curtis. He's been with the staff for almost 5 years as our Chief Development Officer and brings more than 20 years of experience in education and development to the Kansas Methodist Foundation. In Tyler's role, he serves individuals, churches, and related organizations through donor development, working to inspire generosity and facilitate giving to meet individuals or organizations' charitable goals, both in life as well as in estate planning. Tyler has a Bachelor's of Education and a Master of Science in Educational Administration from Emporia State University, as well as an Executive Certificate in Transformational Nonprofit Leadership from Notre Dame. Tyler, we're excited to have you with us today and to present, and I turn it over to you. So welcome.
Sounds great. Thanks, Dustin. Thank you. It's great to see everybody. Appreciate you taking the time to engage in this webinar, and hopefully we present something of value to you. I know we've got several church leaders in the room. We've got several folks who are lay leaders for your respective churches and other ministries. And then we certainly have other nonprofit leaders on the call today. All of us, though, are more than likely donors and contributors to nonprofits. So hopefully this is relevant both from a leader of an organization as well as a person who is giving generously to ministries and causes that are important to you. So I will go through the slide deck today. It will be available afterwards. So you're welcome to take notes, and you'll also know that the slide deck will be part of the after materials that you receive afterwards, as well as a link to view and those kind of things. And I think we'll probably pop it up on our website so people can view it later as well. So I'll go through this. And like Dustin said, if you have questions, ask them. You're free to put them in the chat. We'll be monitoring, hand raises and that kind of stuff. And Dustin, you're welcome to interrupt me anytime if there's a question that's relevant to a slide. I'm happy to stop and can pick up from there. So hopefully you're all seeing my screen now. If you're not, I don't know what to do. So hopefully you're seeing it, and we'll look at what this One Big Beautiful Bill Act did in terms of donor relations, giving, and impacts on gifts that you make. So as we get started, just a little bit about who we are as a foundation. We are a religious foundation. We're a United Methodist Foundation. We're a Methodist foundation that works with people of faith, churches, and organizations. And our job is to help you guys imagine possibilities and imagine possibilities for ministry, and then turn that into reality. Because the reality is, I don't know of a ministry that doesn't require some kind of financial resource to do. Whether it's to pay people or to buy supplies or to do some traveling, some kind of cost is incurred when we are out there serving our folks that we serve. So we hope to try to get people to understand that there is abundance. It is so easy to get trapped into this scarcity mentality, this we don't have enough, and the pie, how do we share the pie with others? The pie is only so big. Folks, the pie is big. The pie is huge. The potential is there. So we want to help you encourage, dream big. Create that vision for ministry that's bigger than what you currently are doing. And I guarantee if you have a big vision and an inspiring vision, the financial resources will come. It's kind of like that. If you build it, it will come. But if you create it, if you imagine it, if you envision it, if it's what God wants you to do, God will make sure it's going to happen. And we want you to put that financial tool in place to make those visions realistic. Our theology of money is Wesleyan. Go figure, right? We're United Methodist, so it's Wesleyan. And it's pretty simple. It's pretty simple. God owns everything on this earth. And we know that because guess what? We take nothing to the next plane. We take nothing to the next place that we go. Everything is staying here. It all belongs to God because it all stays with God. So what are we supposed to do with it? We are receivers. Our role is to receive those gifts, to receive those blessings, and then we are called to take those gifts, take those blessings, and turn them into positive actions for others, for ourselves and others. So like John Wesley said, earn it, save it, give it. We are certainly called to be productive. We are called to take care of ourselves and our families. We are called to love our neighbors as ourselves. So that's how we see money. It's a resource, something that we steward, not something that we own forever. We are temporary stewards of finite resources that stay here and will be passed on to the next generation. So what are we doing today? We're going to talk a little bit about this concept, just one slide on it, about why do people give? Because this might be important to you, especially with this topic related to the One Big Beautiful Bill Act. Why do people give? What changes to our taxes did happen as part of that act, and how will that maybe impact giving to charities? So why do people give? These are the top 10 reasons in ranking order that was presented to us by a person in the fundraising profession who's done years and years and years of research. And the number one reason people give to an organization like a church and like any other ministry or charity that we have is because they were asked. What? They're asked, yeah, they're asked directly. They're asked directly to give. There's a need for people to love mankind. That's what philanthropy is. Love, anthropy, loving mankind, perpetuating ideas and values. Notice these first four, five reasons, they have nothing to do with taxes. Notice where taxes do come in. Number 10. 10 of 10. So what we're going to talk about today is certainly relevant. It's relevant. It's a piece of why people give, but generosity really comes from being asked to do things that are beneficial to others that they want to be a part of. That's where generosity comes from. Taxes are a part of it. So we're going to talk heavily about taxes today, but I don't want anybody to walk out of this webinar today thinking that taxes are the main reason people give. It's not. It's a consideration. It's a consideration, and it is on the minds of people, but it's not in the hearts of people. So today we're talking about the mind of a donor, but the heart is where people lead with when they're being generous. So, so an estate tax exemption. This changed as part of this year's One Big Beautiful Bill Act. So it's increased. It continually increases. Those of you who have been following estate tax exemptions probably at one time saw it as low as $200,000. Those days are gone. Those days are gone. So I got good news for most of you because only about 0.3% of our population has an estate tax problem in our country. So for an individual, when you die, if you leave behind a total asset value of less than $15 million, you don't have an estate tax problem. That exemption is also portable to your spouse if you're married. That means if you're married when you die, your spouse dies after you, there's an exemption of $30 million. That means if your estate value is somewhere south of $30 million, you don't pay estate taxes. And guess what? Kansas does not have an estate tax. So when it comes to estate taxes, when people say, man, I'm really worried about estate taxes, that either triggers you to say, wow, you must have a lot of resources, or did you know that 15 million for an individual and 30 million dollars for a married couple is exempt? Most of us don't have an estate tax problem, and that number is going to continue to be ratcheted up. So there are above the line deductions that are part of this year's bill, and most of us will be able to leverage these in our churches and nonprofits. Some of you remember back after the 2020 time, around 2020, that there was some law put in place that 100% of our cash donations to charity would be exempt up to like $500 or something like that. That was nice, right? That encouraged some of our less our smaller donors, our donors who maybe don't give the big amount, but they were like, oh, well, if I can deduct $500, I'll do that. So this bill puts that a little bit on an increase for the first $1,000 for a single and 2,000 for a married couple. If those are donations to a 501(c)(3) organization, that will be immediately taken off of their AGI consideration. So above the line, at the top of the tax bill, if your AGI is $100,000 and you're a couple and you make $2,000 gift to your church or to a charity, that will deduct that AGI by a full $2,000. That's key, right? Because your taxes are based on your AGI. If you can adjust that AGI down, that means you're going to owe less tax. So these are nice things. This is especially good for those donors in your base that are given 200, 500, 700 bucks. You can encourage them, hey, why don't you increase that to 1,000? Why don't you increase that to 2,000? This is a great way to raise some of those folks at the lower giving level up to that $1,000 or $2,000 mark. I want to highlight here that note at the bottom. This has to go directly to a charity, directly to a church, directly to a charity. Donor advised funds do not work for this exemption. So they want the money to go directly to the charity so it can be realized and utilized now, not later. So it has to be direct. And it is a gift of cash. So anyway, make sure that you have those in your situation because you can really help donors increase what they want to give. There's also limits to qualified charitable distributions that have been raised. So most of us receive qualified charitable distributions, sometimes called the IRA rollover. That's another way of referring to the qualified charitable distribution. Or sometimes people say, yeah, I give my RMD. Um, we think that's a bit of a misnomer. You can certainly give at or the equivalent, part of or the equivalent of your required minimum distribution, but you can give a lot more than that. The rules actually for IRAs and what you're able to do with a qualified charitable distribution is at the age of 70 and a half. So you may not qualify, you may not be required to take that distribution, because that might not happen until you're 72, 74, 75. But if you're 70 and a half, you can make a qualified charitable distribution, and you can make that up to $111,000. That's a hefty amount. Why would you ever do that? So if you have donors who have nice pensions, Social Security, other sources of income, they saved in this traditional IRA, they saved a hefty amount, but they may never use it, they can start giving it at an accelerated rate now. And they can do that to benefit now because when people inherit that traditional IRA, the people who inherit it will pay the tax on it. And they'll pay the tax on it at the rate that they are at, not the person who gave it. So traditionally, as we get older, our income goes down a little bit because we don't need all of that income to live anymore. We already have our house paid off. We already have things that we have in place. So we're not needing and we're not maybe, paying for children and school and all that kind of stuff. So our income can go down a little bit. But if we've saved, sometimes our savings will greatly outlast our need for it. So our donors can actually be encouraged not just to give their RMD, but maybe they want to give a little bit more than that. And those deductions do come in handy for our churches, right? So, by the way, just want to give a disclaimer today. I'm going to be talking about taxes. I'm going to be talking about benefits. I'm not a CPA. I'm certainly not your CPA. Anything that you have here, make note of. Your situation is going to be unique for you. So this is not a stamp of call your financial advisor and have them send your church $111,000. You need to talk to your advisor. You need to talk to your accountant and make sure that's a wise thing to do. I'm just here to tell you that sometimes people don't share the whole story. And as Paul Harvey said, the rest of the story is you certainly can give your RMD as part of a QCD, but you can give more than that if you choose to do so and if it's fiscally responsible for you to make that gift. So charitable deductions, there's locked in the law now a 60% limit on your AGI for cash gifts. That's made permanent. There was a time during 2020, 2021 where that was raised to 100. That 60% limit is now permanent. So for example, if you have an adjusted gross income of $100,000 and this donor is able somehow to make $60,000 in charitable gifts in cash, they can deduct that full $60,000. That's probably going to be unusual, but it could happen if someone's receiving an inheritance or they have a year where they sell a property, they sell something, and all of a sudden they sell a business, and all of a sudden their AGI is way up from where it usually is. If they make that gift in cash, they can deduct 60% of their AGI that year. That cannot be stocks and bonds and those kind of things. It cannot be appreciated assets. But for cash gifts, you can do a 60% amount of that gift. And there is the 5-year carry forward. So if you cannot use all of that deduction in tax year A, you can use it in tax year B, C, D, and E. There's a 5-year carry forward there. So that's a good thing, and that's locked in the law. So cash gifts are more valuable to your taxes than other gifts. However, other gifts are certainly worthwhile looking at because if you're giving appreciated assets, as you know, you're giving pennies on the dollar. So a charitable gift annuity. Oh my, what is this? And why are we even talking about it in here? So there is a rule attached to charitable gift annuities that people need to at least be aware of. What a charitable gift annuity is, it's also referred to as a CGA. That's just the initials. This provides income to a named beneficiary, which can be you, can be your spouse, can be somebody else, but it provides income, and the remainder of that amount that's put into the charitable gift annuity vehicle then benefits a charitable cause. So you put money aside, you get money out of it, and then whatever left behind, the remainderman, that's what goes to charity. The benefits are that this is an income management tool as well as a tax avoidance tool. So in general, this is how it kind of works. You as a donor make a charitable gift annuity agreement with a foundation like the Kansas Methodist Foundation. In that agreement, you give money to the foundation, and then you tell us how much you want every year. You annuitize that. So that typically amounts to somewhere around 5% of the distribution there, but there's a table that we have to follow. So we calculate that table and we say, here's how much we're going to give you an income every year until you die. And the remainderman then you tell us where you want that money to go to serve your charitable cause. So that's how a charitable gift annuity works. Why is it part of this presentation? Because the rule, oh, sorry, before I get to that, why would someone do this? Well, first of all, you have to have charitable intent. You typically will have assets that have appreciated. This is not something you want to fund with cash. That's not an advantage, but you can transfer assets into it that have appreciated, and you can avoid the capital gain thereon. So if you have a rental property, if you have inherited land or own land, if you have stocks and bonds that you have and they have greatly appreciated, well, you can roll those into a charitable gift annuity and not pay the capital gain and then get some income out of it throughout your life and perhaps your spouse's life. And then at the end, the remainder goes to a charity. It gives you an annual income stream and it regulates that annual income stream as well. If you really want, because this is annuitized, we guarantee this is the amount we're going to give you every year. It doesn't fluctuate. It's annuitized. Here's how much you're going to get. So you can count on that every single year. So the thing that this applies to with this rule, this law, is that there's a once in a lifetime QCD that can be rolled into a charitable gift annuity, which means somebody could take up to $55,000 and put that into a charitable gift annuity that would then pay them income. So this is a one-time rollover. You can only do it once. But if you're someone that's a non-itemizer or an itemizer, that gift is not subject to the charitable floor or the caps. So that's it. It's a nice advantage for some people. This is something, again, you would really want to talk to your financial advisor and your accountant to say, look, I've got this balance in my IRA. I want to roll that into a charitable gift annuity to provide me a level amount of income throughout my and my spouse's life. If I did that, what would be the benefits? So this is something that you really have to calculate for yourself, but it is in law now that you can make this rollover from your IRA to a charitable gift annuity in the amount of up to $55,000. So that rule exists. Not going to be appropriate for everybody, but it's something in there that you need to know about. And if you're the charity, you could say you encourage a donor to do this and then make you, your church, your charity, the beneficiary of the remainderment. Obviously, that's going to be a payoff at some point in time down the road. So it's not going to be an immediate gift to you, but it's a way of making a planned gift to your charity and to your group. So, just a little bit about how tax liability works, because I think there's sometimes just some confusion around how these things are calculated. We have 7 different tax rates in our country that depend on the amount of income that you have, right? So, for a single filer, this is what the tax table looks like for 2026. So, if you're somewhere, north of $12,000, you're going to pay more than 10%, right? It's a graduated, progressive tax structure. So these are where the single filers come in. So if you're a single filer, you can kind of estimate what your income is going to be for 2026. And this is the bracket that you pay in. Again, you never pay. So if you're in the 22% bracket, you don't pay 22% off the top. Your first 10,000 is taxed at, or your first 12,000 is taxed at 10%. Your second 20 or 37,000 is taxed at 12%. Your next group of money is taxed at 22%. And I'll show you how that kind of adds up. Um, Most of us in today's world use a thing called the standard deduction. Again, this amount has really increased the last 10 years, right? A lot of us used to itemize. A lot of us do not itemize anymore because the standard deduction off of our AGI has gone up so much. For 2026, it's $16,100 for a single or $32,200 for a joint. In translation, to itemize today, things like mortgage interest rate, your state and local chat taxes, your charitable donations, however they're figured, whether 60% or 30%, whatever that might be, your medical and dental expenses have exceeding the 7.45% floor. All of that has to add up to more than 16.1 or 32.2 in order to itemize. So most tax filers today are not itemizing. So this is a standard deduction that's really utilized heavily today, which makes it easier to figure your taxes, but it also means that donors don't always see the benefits of their donations as they used to at one time. So let's just say this is a single filer who makes $75,000 and they're gonna use the standard deduction. So they're going to take that 75,000 adjusted gross income, and again, that will be an adjusted gross income. Your accountant will figure that out. You can figure that out. I'm not going to figure that out for you, but we're just going to use for the sake of the example that has been adjusted and it's at 75. They take the standard deduction And that means that $58,900 is taxed. That puts them in a 22% tax bracket. So what does that mean? That means their first $12,000 equates to $1,200 in tax. Their next $37,000 equates to $4,440 in tax. And then the remaining $9,900 is taxed at 22%, which figures out to 2178, and their total tax bill for that year is 7818. That's what that looks like for that single filer. Now, if they make that $1,000 deduction to their church or charity, if they do that, that is taken off of their AGI. So again, $75,000 is their income. They take the standard deduction and they can take that $1,000 deduction to bring their taxable income down $1,000 to 57,900. So what does that look like? Again, their first two rates are going to be the same, but their second rate, instead of $9,900, it's only $8,900. So that equates to about 75.98, which means they made a gift. It could be a gift they're already going to make anyway. It could be a slightly raised gift. Again, for those folks that give you $500, $250, $700, encourage them. Go ahead and step that up to 1,000. You'll actually save $220 on your taxes in this scenario, and you've made a gift that you probably want to make anyway. So this is a win-win. They get to have a little bit more of a deduction, and they're actually going to save on their taxes. Not a huge amount, but I mean, less is, hey, I'm still paying in less. So if you are a joint filer, the tax tables are about double, right? You go figure. This is about double. Same rates, same marginal tax brackets, but the rates go up. The household income, those levels go up. So what does this look like then if you're a single or a joint filer? Let's just say we double that income. You're a joint filer. You each make, or your total income adjusted is $150,000. Well, you're going to take that 32.2 off because again, this is a household. This is a joint filer. So that means that's 117,800 is going to be put you in that 22% tax bracket. That's one of the most common tax brackets across the nation. So the first 24,000 again is taxed at 10%. The next 74,000 is taxed at 12%, and then that remaining 19.8 is taxed at 22%. So that means this joint filer has a tax bill of about 15,636. Now, if they go ahead and make that $2,000 gift to Charity A or Church A or whatever it might be, they can make that off of their adjusted gross income, and that again will filter down to what they actually owe in taxes, and they can save about $440 making that gift to their church that they're probably going to make anyway, or that gift to that charity. So smart donors this year, where regardless of how you make your gifts, will probably consider, if they're single, making $1,000 in gifts off of their cash flow. If they're married, making that $2,000 gift off of their cash flow. That's a smart thing to do this year. So Dustin will share a little bit about some of his strategy for this year. But if you are a regular donor, it is worthwhile for you to go ahead and make that $1,000 gift and that $2,000 gift if you're married out of your cash flow, and then consider other ways to make gifts that are over that. But those are really encouraging kind of things. And I think a number of our charities can speak to that when they encourage their donors to make gifts this year. If you are an older American, there is, there's no great way of saying this. I don't know. If you're over 65, I don't know. But this is an older American's tax benefit. If you are over 65, you can actually claim an additional 6,000 deduction for single, 12 if you're joint. If your AGI is below $75,000, single, $150,000 joint. That's a big benefit. So our older Americans, the older people in our churches and that are on our donor rolls, they're going to get a nice deduction with this. It phases out up to 175,000 individual or 250 for joint. But just know this, if your donor base has a lot of people over 65, they may be looking at some deductions that make it beneficial. Also, it frees up some cash flow for them. Um, so these deductions are above, they're in addition to the standard deduction. So that standard deduction of 16,1, 32,2 can be increased to over $40,000 to over $18,000. These are nice, or $20,000 rather. These are nice deductions that, and a lot of our donors, let's face it, are 65 and over. So remind them that they might have a little bit more jingle in the jangle, and they can maybe encourage them to share that with you. Dustin, you have kind of talked a little bit about how you're going to change your behavior as a result of the One Big Beautiful Bill Act. Chat a little bit about that, if you would, and then we'll look at what it looks like to itemize.
Yeah. So for everyone's awareness, my spouse tithe on the income that we receive, and the way that we have been giving our gifts primarily has been through a donor advised fund. And so we've been clumping into a donor advised fund. And when we do that, then we itemize in those years. And then the donor advised fund makes distributions on behalf of us to our church and other charitable causes. Um, and we don't give those gifts. The donor advised fund does, and we spend it down and then we'll load it back up. But because of the One Big Beautiful Bill, we're actually intending to give cash gifts up to this $2,000 so that we can have that above the line to distribute or deduction. And then the remainder of our charitable giving is going to come from the donor advised fund. So we're going to have really two methods of giving in this year: the cash gift up to $2,000, or at least $2,000, and then also using the donor advised fund. I saw a couple people who made comments about the giving from an IRA in the registration and consideration for this. And if I was in that situation, so if I was 70 and a half years of age and I had a traditional IRA, I probably would, talk with my accountant, obviously, but I probably would plan to give cash gifts up to this $1,000 or $2,000 above the line, and then the rest of my giving would come from a qualified charitable distribution from my IRA to fulfill my pledge and my charitable wishes. So it might be that we'll have families that do modifying of both to fulfill your giving to support your church or other charitable causes.
Yeah.
One final piece about donor advised fund, since I already brought it up, we're not spending much time on a donor advised fund. I'll put into the chat our other presentations. We have a donor advised fund presentation that we did a couple years ago that might be helpful. But the key places where people use donor advised funds are when they clump gifts, like what I described in how my family does it, or if they're trying to offset a really large windfall or some kind of high income event. You sell a business or something and you want to offset that with a large charitable gift into a donor advised fund. So those are my thoughts.
Thank you, Dustin. Thank you, thank you. And obviously, if that triggers some questions and some thoughts, Dustin will also be on here, obviously, to help answer questions as well. Um, so our last kind of area to look at with this act is how it affects folks who do itemize. And I'll tell you, if there's a confusing part of this act, this is where the confusion comes in. They did a few weird things with folks who itemize that create some complexity. So if you can itemize, and again, that means all your deductions have to add up to more than 16,1 or 32,2. So again, it's a high standard, but if they do and you itemize, there is a new 0.5% floor on your charitable deductions, which means that you cannot deduct a gift to charity that is the first 0.5% of your income, which is that adjusted gross income. So what does that mean? Um, well, hopefully. If your taxpayer has an AGI of $200,000, okay, this is their adjusted gross income, and their charitable contributions for that year equal $10,000. That 0.5% floor is 0.5% of their AGI, which is $1,000. And that means that the itemized charitable contributions are only going to reflect $9,000, not 10,000. So that first $1,000 does count for carryover, but it is not utilized in that tax year. So that's a little bit different. That's kind of a head scratcher. Like, why did they do that? I don't really know, but they did. So your accountant's going to be looking at your total contributions, and if you are itemizing, the first 0.5% of your AGI is not going to count towards your deductions. Okay, so that's a little bit different. There are also special rules for high income earners. So if you do fall in that 37 percentile, which is only 0.7% of our taxpayers in the nation fall in that highest tax bracket, that means that an individual has more than $640,000 in annual income adjusted, or a couple has more than 768,000 again adjusted. So if they fall in that, there is a special rule for them. And here's what their tax table looks like. Just standard, right? So if you make $900,000 and you take the standard deduction, again, you're not itemizing, so I'm not going to go into a lot of details about the various options here. But here's what that looks like. So as you can tell, if you're a higher income house, you pay tax, of course, at all tax brackets, including that 37%, which on 900,000 equates to over 244,000 in tax liability. So these folks have a high tax liability. So they're looking for ways to reduce that typically. In a good way. So if they can itemize and they have that $1 million, just using a more round number, and they make $100,000 gift that year, there's a 237th rule, which means rather than the 0.5% rule, um, the first 237th or 5.4% of that is not able to be deducted. It can be carried forward. But that means that first $5,400 is not going to count towards their deductions if they itemize. So they're only going to realize a little less than 95,000, 94,600 for those deductions on that year. Now the good reason, the good news is this, right? Tax reasons are among the least important to donors in general. So I don't think we need to worry necessarily that our high income earners are not going to make gifts anymore, but they're also not going to realize quite the amount of benefit from making those gifts. So this probably behooves of us to make sure that, especially for these donors, that we're talking to their heart, that we're encouraging them to be generous and kind and loving and impactful, beyond whether or not they're going to receive a tax benefit from it. Because again, I want to really emphasize this slide. Donors give because they're asked to engage in meaningful work that they want to make a difference in. That's why they give. That's why they give it. Other people are doing it. They want to they want to help that charity reach their matching. They want to maybe memorialize some of that. That is even towards the bottom, but taxes are the least of their worries. What they really want to do is make a difference. But just know that there are a few things that encourage our lower donors to step up. There's also some things that incur that maybe from a tax perspective would lead people to maybe double think about the avoidance, but really, if they're generous people, kind people, loving people, I don't think we're going to see them change their behavior. up to like a degree that's going to affect us too much. But there is that in there. There is that in there. So at that point, I will stop this. I've got a few things to tidy things up, but what questions do you have in the group? We want to make sure that we allow some space for those questions to take place. So, what questions might exist out there that you want to ask Dustin or myself to respond to? And there may even be somebody on the call today who can add in some things. So, any questions? I've never known Rob to not have a question, but maybe she's just being really nice today.
Uh, Looks like Amy's got a question.
I did. And I was taking notes and I might have missed this as well. So the charitable contribution of $1,000 for a single, 2,000 for couples, is that capped at 2,000 for a married couple to take off of the AGI?
Yes. Yeah.
Okay,
Yeah. Like the immediate. So if they use the standard deduction, and they make more than 2,000, then they're not going to see the benefit of that extra giving.
right.
Um, but, uh, but if they itemize, they could receive more. Does that make sense?
Yes, that was going to be my next question is if you itemize, you still get the $2,000 off the AGI plus then anything above that 2,000 would then count toward the itemized.
No, the
It's one or the
1,000.
other.
It's one or the other. Okay, that
Yeah,
Yeah.
yeah,
got it.
yeah. If they take the standard deduction, they can use that 1,000, 2,000. If they itemize, then it goes into that other rule.
Okay,
Yeah,
got it. Thank you.
but again, like 90% of our tax filers use the standard deduction. So it's a
Yeah,
large percentage of our of
right.
our donors use the standard deduction, so they can really leverage that $1,000, $2,000
Sure.
contribution. So I saw a question in here about the annual gift exclusion. That's $19,000. So that's for an individual. That's for an individual. So if your individual is like giving a gift to like a loved one, the gift exclusion is now $19,000. So let's see, is the extra 2,000 charitable deduction increased to it's not in effect only for 2026, it's permanent. So that's a permanent, and I expect that there will probably be some adjustments to that amount, but I don't think there's automatic triggers. Dustin, is there an automatic trigger to increase that, or is it set at 1,000, 2,000 until further notice?
As far as I understand, it's fixed and but will be there until Congress changes it in the future. So
Yeah.
it's not just 2026.
Those QCD amounts, those are ramping up
Yeah.
every year, and I believe those are automatically triggered by previous legislation, um, but uh, but not the standard or not that deduction. Let's see who's a resource for ranking order of. Oh, it's Robert Swanson, Swanson House Consulting. Runs a fundraising organization kind of like Horizons. And he has I don't know if he did the study or if he got the study, but it is a nationwide study though on how donors act and where they come from. So that does credit back to Robert Swanson, Swanson House Consulting. Thank you. Sorry, I missed that.
Let me say to Amy's comment, so let's pretend a family gives $12,000 as a charitable gift for a couple filing jointly. So that's their normal gift, which is not enough for them to probably itemize on their taxes. But they will now, a new benefit is they'll be able to reduce their adjusted gross income by this $2,000, where they last year they would not have been able to do that for their giving. And so you still get a benefit in the sense of the standard deduction. It's just it's a pretty high standard deduction that will reduce their income.
Good point. Other questions that are
Hey,
floating
Tyler,
in?
question
Yeah,
about the higher deductions for seniors. I mean, obviously that's a tax break for seniors.
sure.
What do you think is the giving implications to that?
Well, if we run the calculations, they'll have more, they'll have more in their pocket and less going to the government. So there's more potential for those Americans 65 and over to be more generous. So certainly, I think as folks who are working with donors and people who are donors themselves, I think you just need, I mean, I think you just need to have that in your mind that there will be more capacity for annual giving with 65 years and over. Um, so hopefully that's a good thing. And if they're good, loyal donors, they may be able to step up their giving because they have more flow. So Dan, someday you'll be there. Dan's from Wichita and the Chapel Hill United Methodist Church, and he's a great person. He's got a story on our website, I think. I think you guys have a nice story up there. So if you want to learn more about Dan, he's there. He may or may not be over 65. I certainly won't tell you about his wife.
Hey,
Phil, do you
Tyler,
have something?
no, didn't know if everybody realized that even if you take the standard deduction and don't itemize on your federal, you can still itemize on your state.
Correct. It's a good point. It's a good point, Phil. And I certainly did not go into our state levels, but you're exactly right. So again, this is an encouragement, right? Talk to your accountant about what the impact of these gifts and certain tools that you want to utilize, how those really affect you. Would a QCD to a charitable gift annuity be a difference maker for you? Would a gift of cash versus a gift of stocks and bonds be useful for you? Does this year need to be maybe a year that you make a gift to a donor advised fund to then utilize to support your charities in future years? That may be that clumping strategy that Dustin talked about. Ask them about it. The more informed you are about questions to ask people who can really run your unique numbers, the better. And we just want to put you in a position to be knowledgeable about what to ask. Because frankly, sometimes your advisors won't offer it unless you ask, right? There's a lot of financial advisors that are great people. They're great people, but they wouldn't maybe encourage you to look at that $111,000 gift. Because that ultimately that is money that they're no longer managing. Again, they're good people and they're supporting you and they want to make sure that you're secure. But you've really got to look at, are we managing for the future, or are we doing the best of what we have? Are we being good stewards of our resources? Mickey, do you have something?
Nope.
Oh, I saw you unmute there, so I thought maybe you did. And her husband, by the way, is a financial advisor. I would never talk bad about Tracy behind his back. I'll tell it right to his wife's face. Anything else? Well, I've got a few little things here to wrap things up then. And if you have a question, by all means, ask away. But you might have heard of this guy, Ronald Reagan, who had a kind of a famous quote, we're here from the government, and it's terrifying, right? And I'm here to help. We are here to help you, though. We are here to help you. And we're not from the government, we're from the Kansas Methodist Foundation. But how can we help you? How can we help you? One thing, we can provide assistance. Again, we're not attorneys, we're not CPAs, we're not financial advisors, but we work with a lot of people on their giving, and work with a lot of advisors and accountants and attorneys, so we can at least encourage your planning process to walk through estate planning, and even just like year by year, what kind of considerations do you need to make, and we can help guide those questions. We won't provide the answers, but we'll provide you with the questions to ask of the people who know about your situation. We can connect you with an attorney, especially if you're looking at things like how does this impact my overall estate? And so we can connect you. We have a network of folks across the state who we work with that can do that kind of work. And then we can give you access to an estate planner as well. We have an individual on retainer, so to speak, but it's Stewardship Counseling, John Griffin, and he works with nonprofits. He works for the nonprofit, so he works for the Kansas Methodist Foundation, and then we allow access to him from folks who we work with. That's a free of charge kind of thing. That's just a service that we provide to our Methodist so that they have some access to professional advice without the without being charged for that. And it's certainly something that we've found of value to people. We also offer a putting your house in order program. We just started these cohorts last week, but we do have the on-demand option. So if you are somebody that is looking at how this affects your estate, if you need to re-look at a will that's maybe 30, 40 years old and dusty, if you want to look at what it looks like to put together a trust, we can certainly guide that kind of conversation as well as talk about giving and memorial planning as part of that. So we've had a little over 225 Methodists go through this program the last couple years, and we find it to be of value. And this is John, who we can connect you with too if you need that kind of help and assistance. Of course, Dustin and I are always here as well to assist you. Thanks for being on today. Thanks for being part of this webinar. We appreciate you, and best of wishes on your ministry going forward. We're grateful.